Welcome again to EBRI's Self-Insured Health Plans Trends e-briefing, a closer look at the smaller employer market. I'm Lori Lucas, President and CEO of EBRI, and I'm delighted to introduce this session. When the Affordable Health Care Act was passed, the prevailing wisdom was that ACA would cause more small employers to adopt self-insured plans. Clearly, since then, the ACA has had its ups and downs. And the question is, how has ACA's impact on self-insured plans played out? In that context, in today's e-briefing, we'll explore the pros and cons of self-insurance for small employers and the effect of the current regulatory framework on the market. And I'm very pleased to introduce our speakers for today. First, we'll hear from Paul Franson, Director of EBRI's Health Research and Education Program, who will discuss his findings from his recent issue brief on self-insured plan trends by firm size, which is available on our website. We will also hear from Chris Holtmeyer, Vice President of Legislative and Regulatory Policy for Blue Cross Blue Shield Association and EBRI's Vice Chair of Healthcare Research, who will weigh in on self-funding in the small employer market. And we'll also hear from Chris Condalucci, founder of the CC Law and Policy. Chris is also the Washington Counsel to the Self-Insurance Institute of America. He is an employee benefits attorney by training, and he served as tax and benefits counsel to the U.S. Senate Finance Committee. During his time in Congress, Chris participated in the development of portions of the ACA, including the exchanges, the insurance market reforms, and all of the new taxes enacted under the law. Based on his experience as an employee benefits attorney, Chris possesses a unique level of expertise on matters relating to tax law, ERISA, and the ACA, which he'll bring to bear in our discussion today. Please remember to type in your questions into the Q&A box at the bottom of your screens, and we will take the questions at the end of the session. And now I'll turn it over to Paul.
Thanks, Lori. And let me just thank all of you for being on the webinar. Appreciate your interest in the work we're doing here at EBRI, as well as the thoughts that you're going to hear from Chris Holtmeyer and Chris Condalucci. We released this issue brief on trends in self-insurance back in February. And here, just, we wanted to make sure everybody had a link to the issue brief as well as a link to the fast facts. That's a shorter version of the issue brief. So feel free to download those at your own convenience and read them in greater detail. We do have a few polling questions that we want to start off with, if we could bring those up. If we could bring up the first one. So this first question is just to get a sense of how large the companies are that you work for. And even if you're not here as a participant, as an employer, everybody, or probably close to everybody that's participating, that's listening in, works for a company, and think about how many employees are at the company you work for, and you could use that. How many companies there are domestically for the company you work for? So we'll give you just a minute to answer that. Okay, do we want to? Can you let's tally the results, get a final number? It certainly looks like most people on the call, on the webinar, are employed by larger firms. Almost half employed by firms with 1,000 or more employees, and then there's a pretty good concentration of people employed in firms with either 100 to 499 or 500 to 1,000 employees. Let's go to the next polling question. The next polling question is whether or not your company offers at least one self-insured plan, and hopefully you know the answer to that. If you don't, you could choose don't know. But if you know whether or not at least one plan is self-insured, it's a lot of employers will offer a mix of self-insured and fully insured plans. So as long as one is self-insured, please choose the self-insured option at the top. I'll give you a chance to complete this. Other than the don't knows, it's coming in nearly half and half. which may be surprising given the strong concentration of people that work for large companies that we do have. Why don't we'll wait one more second to tally the results, but it looks pretty evenly split between those that are working for a company that offers at least one self-insured plan and those that are working for a company that don't offer any self-insured plans. Why don't we view the votes? Oops. Okay, and then the next polling question is, if we go to the next polling question, for those of you who said about half of you that are not in a self-insured plan, do you know whether or not your company's thinking about it? Or have you thought about it? So here we're seeing about 40% are currently exploring it. No surprise, given that most of the participants on the call are in large companies. 20% not yet exploring options, and 40% are not exploring. Yes, they're interested, but they're not yet exploring options, and 40% are not exploring options. Okay, so we could move on from the polling questions at this point. But clearly, it's an interesting dichotomy between this audience and what we found. The audience here tends to be employed by larger firms. Super majority employed by firms with 100 or more employees, and quite a few employed by firms with 1,000 or more employees. Yet only about half are in firms that are in self-insurance. But among those that aren't, there's certainly an interest in moving to self-insurance. So, as Lori said, there's a lot of interest in self-insurance post-Patient Protection and Affordable Care Act. The key components of the ACA were expected to drive up the cost of coverage, and you can see the key components here. And as a result of the expectation that the cost of coverage was going to go up, self-insurance was expected to be a more attractive option for many fully insured employers, which tended to be small and mid-sized companies. So we have been taking a look at data from the Medical Expenditure Panel Survey insurance component. This is an annual survey of employers that dates back to 1996, though I would note that they skipped the survey in 2007, so you'll see in the following charts there's no data for 2007. The survey is conducted by the Census Bureau on behalf of the Agency for Healthcare Research and Quality. The survey collects data on the number and types of health insurance plans offered, benefits associated with these plans, annual premiums, employer and worker contributions, as well as lots of other information about health plans. AHRQ does not release the raw data publicly. It publishes summary statistics from that data. The raw data is confidential, and you can only get access to that data if you go to one of the Census Bureau's research data centers, and you need to get permission from the Census Bureau to do that. You can't just show up. It's a great survey, though. Nearly 40,000 private sector employers completed the survey in 2016. It's a terrific sample when it comes to an employer survey. Most employer surveys tend to be much smaller, with maybe a couple hundred to a couple thousand most employers interviewed. So this is a very rich, very reliable survey to track trends in self-insurance, especially when you get into the small and medium-sized group, because once you start cutting the 40,000 by firm size, you still have a great sample, a very reliable sample of small and mid-sized companies. And what we have found over the long term is that the percentage of private sector establishments that are offering a plan, offering health insurance and self-insuring at least one plan has been trending upward. It's not a straight upward increase. You do see some years where it drops, but for the most part it's been increasing. And as of 2016, almost 41% of private sector establishments were offering at least one self-insured plan. And that's in line with the answers we got from the polling question, which found that among those of you that know whether or not your employer is offering a self-insured plan, it was about half and half, 50% were and 50% weren't. So we're in the ballpark there. The difference, though, between all of you on the phone and what we're finding in the survey is that most of you work for large firms, and large firms are much more likely to offer a self-insured plan than small firms. So this slide shows you the trend by firm size just for the last 3 years. It would be way too messy to show this. We do have more detail in the issue brief, so I do encourage you to take a look at that. But here you see that for 2016, which is the green bar, hopefully it's shown up as green on your slide, among employers with 500 or more employees, 78.5% were offering at least one self-insured plan. Among employers with 100 to 499 employees, those bars in the middle, 29.2% were offering a self-insured plan in 2016. And among small businesses, those defined here as less than 100 employees, 17.4% were offering a self-insured plan. But look at the trends are what's interesting. I mean, we know that large employers are much more likely to offer a self-insured plan than small employers, but the trends here are interesting. You see that among larger employers, there's actually been a drop in self-insurance. It's gone from almost 81% down to 78.5% in just 2 years, whereas among smaller employers, those defined here as under 100 employees, you see this upward trend with a relatively big increase between 2015 and 2016. Overall, across these 3 years, it went from 13.4% to 17.4%, which is a relatively large increase. And for mid-sized companies, it's a little bit more difficult to conclude what's going on. You see this relatively big jump between 14 and 15, but then it drops a little bit between 15 and 16, and we're not really sure if that drop between 15 and 16 represents a reversal of the trend, a flattening out, or maybe just a temporary pause in an increase in self-insurance. So we'll move on to, so that's looking at it from the employer perspective, the percentage of employers. When you translate those numbers into percentage of workers that are in self-insured plans, there you see there is definitely a trend upward, less dramatic than in the previous slide for employers. But here you do see a drop between 15 and 16 in the percentage of workers in self-insured plans. And when you go to show this by firm size, it's because there's a very large drop among large employers, those with 1,000 or more employees. You can see between 15 and 16, the percentage of workers in large establishments that are in a self-insured plan fell from almost 86% down to 81.5%, where it's increasing in the smallest of the small, that is in firms with less than 10 employees, and it increased among firms with 10 to 24 employees and 25 to 29 employees. You may be asking, how come we have different firm size cuts when we're looking at employers versus employees? And that's because we're using the published tables that AHRQ released, and that's the way they cut it. So this is the most detail that they're releasing publicly. They didn't line them up for whatever reason, and so we have to show them given the way that they do their tables. Okay, so conclusions: increase in self-insurance among small employers, an increase in self-insurance among mid-sized employers that might be reversing itself in 2016, and self-insurance among large employers is falling. We will update this study in when the 2017 data is available later this summer, so be on the lookout for that. And we are able to do, just so you know, we are able to do other types of cuts, even though we can't change firm size cuts. There is some flexibility with the way we are able to cut this data. It's something we do for our members, and if anybody's interested in that, please don't hesitate to let me know. So with that, I'm going to turn it over to Chris Hallmeyer.
Thank you, Paul. So I'm going to drill down a little bit. I'm going to drill down a little bit more on some of the trends we're seeing in the small employer market related to self-funding. And you know, I've been asking Paul to take a closer look at this market for some time because it really is regulated in a unique way under the ACA. So typically, or traditionally, the small employer market has been regulated by the states, and the states have imposed a set of rules that were a little less restrictive than the rules that exist under the ACA. So in most states, you had the ability to rate small employers based on some amount of health status, typically a plus or minus 25% band. You had the ability to rate based on age. And with the ACA now, beginning in 2014, we've had a market that's moved to a modified community-rated market, where for the insured market, you can no longer use the health status of employees in determining the premium for an employer. All of the groups in that market have to be combined into a single risk pool. So really there is no variation based on the characteristics of the employer, at least related to health. There are some limited demographic characteristics related to age banding. So in this new environment, more firms are experiencing rate changes as they move from pre-ACA policies to post-ACA policies, and in some cases, because of these rating changes, they're getting some significant rate increases. In response to this, we're seeing more companies offering self-funded alternatives in the market, and we're seeing an emergence of products that are called level-funded products that combine self-funding, a stop-loss policy, and administrative services. And I'll talk a little bit more on a couple slides in the future here about how those arrangements work. But we're seeing these arrangements now being offered fairly commonly to firms with as few as 25 employees, and in some cases to firms with 10 or fewer employees. And these are being offered now by more mainstream companies with good brand recognition as well, which is kind of a difference in the market. When you consider these self-funded options, they are oftentimes much more affordable than fully insured options for employers that can benefit from underwriting, so for employers that have a lower health claims costs. On the next slide, I'm going through some of the options that you see in the market today. So in a typical self-funded arrangement, which is what we have on the left, the plan sponsor bears all the financial risk of paying claims as well as the cost of administering the plan. The employer may purchase stop-loss coverage, but the attachment points are typically well above what the expected claims cost would be for the group. In a fully insured arrangement, you would have the employer purchasing a health insurance product where the risk is transferred to the insurer for all of the claims under that plan. In this middle category, though, these hybrid arrangements, which are becoming more common, there's a combination of a self-funded plan with stop-loss insurance and administrative services that provides access to providers and claims processing. The employer assumes the risk of paying claims up to a specified level, called the attachment point. Once the employer's claims in a given year exceed that attachment point, the stop-loss policy fully covers their costs. And what we're starting to see with some of these stop-loss policies is that employers are purchasing policies with lower attachment points and not bearing as much risk as they would under a traditional self-funded arrangement. Next slide. We're also seeing the emergence of some new products that are having a fixed monthly payment to the carrier. These are what I refer to as level-funded products that covers a paid claims fund as well as the stop-loss coverage and administrative fees. So this operates a lot more like a traditional insurance product in that the firm is making a payment or two separate payments that are level throughout the year, much more like they would with paying for a traditional insurance product. Some of these products also offer the potential advantage of having a rebate if claims are lower than expected. The major thing I think to keep in mind with these products is that they are underwritten. So to the extent that a carrier would have claims that are lower than what an insurer could offer in the traditional insurance market, the firms can't benefit from that in these types of arrangements. The National Association of Insurance Commissioners has developed some rules around stop-loss coverage. They have a model law that defines stop-loss coverage from 1995. That model law requires that the attachment point be at least $20,000 for groups under 50 employees. Aggregate stop-loss must attach at the greater of $4,000 per person. 120% of expected claims are $20,000. In general, this would be 120% aggregate level. But they haven't updated that model since 1995. They did look at this back in 2012, and at that point we're looking at establishing higher individual and aggregate thresholds. But those changes were not finalized, and most states have not adopted this model or similar regulations. Next slide. So as I mentioned, I've been asking Paul to take a close look at this market for some time because we do expect that over time you will see a significant migration towards these self-funded arrangements and away from traditional insurance coverage. We've talked about the unlevel regulatory treatment of self-funded arrangements relative to traditional insurance products in terms of the rating. They also have much less benefit flexibility because they have to meet these essential health benefit requirements and are also subject to risk adjustment under the ACA and are subject to paying the health insurance tax and state premium taxes. So there can definitely be a advantage cost-wise from those factors. There are also new changes occurring in this market that may be moving people more towards self-funding. It includes the introduction of new coverage options, including association health plans. There are also some interactions with the individual health insurance market where the market may have been impacted by some firms moving to individual coverage. Maybe some are actually moving back now. I'm happy to talk about that if there are questions about that. And then we're seeing, much greater availability of self-funded options that are marketed towards small firms, and especially firms with lower claims costs. We've even seen some marketing materials that say, if you've got low claims cost, you should enroll in this coverage. But if your claims start to deteriorate, you should move back to the traditional insurance market. So that's obviously something that's worrisome. And then we are seeing greater interest, at least in some states, in these types of arrangements. And this is particularly from firms that were benefiting from the previous rating rules in the market. The impact of some of the changes in this market have been mitigated by the transition policy that the Obama administration issued back in 2014. Where you could keep the coverage that you had. So you still have a significant number of firms in the small employer market that have not come into compliance with the ACA rules. But when they do come into compliance, they're given the option in many cases of opting for a self-funded arrangement. And that may be attractive, especially if they're a lower risk firm. So over time, we do expect that this will have a destabilizing impact on the market. On the next slide, I just wanted to show you some data that is a slightly different look from what Paul showed to you. So this is data from the National Association of Insurance Commissioners that was compiled by Oliver Wyman. It also includes data from the California Department of Managed Healthcare, which reports data separately. And it's looking at the covered lives for insured products in the small employer market. So that we define this as under 50 generally, although there are some state exceptions in how this is reported. But as you can see here, the enrollment in the small group market has declined by about 30% since 2011. And that's in contrast to fairly stable enrollment trends in the large employer insured market. Over the same time period, premiums have increased by about 32% in the small group market. That's actually pretty comparable to medical trend in the small group market. So that doesn't really show much deterioration in terms of the risk pool at this point, but I think that has a lot to do with the fact that you have this transition policy still in place that protects some of the healthier firms from these rate changes I've mentioned. And you also have some other things happening in the market where some of the very small firms migrated to the individual market, and you may have some firms buying down to lower AV plans as well. I think this is something we're going to have to monitor very closely over time, and at some point we may actually have to reevaluate the rules that apply in this market, because it's kind of hard to see how you can have a stable marketplace if you have two sets of rules in the same market for small employers. So why don't I stop there and turn it over to Chris Convolucci.
All right, thanks. Appreciate it. Let me see if I'm advancing the slides appropriately. There we go. All right, modern technology at its best. Works. So what I want to do is almost take a step back, right? So we looked at the trends that Paul went through. We heard from Chris with respect to some of the products that are out there and some concern about market impact. But maybe I'm even looking at this too elementary from a too elementary of a perspective, but it's almost like, why are folks self-insuring? Like, why do employers self-insure? And what are the benefits associated with that? Because arguably that explains some of the trends that Paul spoke to, and some of the products that are available may also be enticing to folks to say, yeah, I'm going to pull the trigger on self-insurance, which really gets to almost this slide, and forgive me for the typo at the beginning. My title of the slide was Self-Insurance for Everyone, but then I wanted to change that for every employer, and I obviously left out the word every. So think of that title as Self-Insurance for Everyone. And you see my first bullet here saying it's important to understand that self-insurance is not for every employer, because it's not. Self-insurance, yes, is an option for employers who want to offer health benefits to their employees, but self-insurance isn't for everybody. And really, why is that? Well, an employer, regardless of their size, for all intents and purposes, has to have enough capital on hand to take on the financial risk of paying their employees' own health risks. Because at the end of the day, that's what self-insurance is, right? The employer is taking on the risk and funding the health claims for their own employees, period. So the employer is acting as their own insurance company, and they're on the hook for from a financial perspective. And if you're an employer that does not have the right balance sheet, if you are, operate on, debt is part of your business model, and or you are operating on a shoestring, self-insurance is not for you. But if you do have the finances and you feel that you can take the risk, oftentimes employers do. Again, regardless of size. The demographic of an employer's workforce is also a key factor. I mean, this is Insurance 101, right? But it also kind of allows you to determine what industries might be more likely to self-insure versus other industries. If you are an employer in a high turnover workforce, typically you're not a good candidate for self-insurance because your employees are not sticking around long enough for you to really make an investment in managing their health and making sure that they are a productive, healthy worker. So if you have this high churn, typically self-insurance is not right for you. Also, if you have an unbalanced risk pool for one reason or another, because your demographics skew old, or you do have some high medical utilizers in your risk pool, you obviously are not a candidate for self-insurance, because the last thing the employer wants to do, which is taking the financial risk, to be on the hook for significant health claims that they might not otherwise be able to cover, which almost brings us to this push and pull between, should an employer go fully insured? Should they go self-insured? If they go self-insured, they might be doing so because they have a balanced risk pool and maybe one that skews healthier. But then what does that leave for the insured marketplace? Well, it leaves the less healthy folks, and that has an impact on the market, which to extent is what Chris H. spoke to. And there are reasonable concerns about impact on the fully insured market. I have no illusion to that. So moving to the next slide, and it's again, why do you self-insure? We talked about kind of, is self-insurance for everybody, and we've established that it's not, but it is for some. And for those that do find that self-insurance is an option, why would they do it? Well, when you self-insure, you really, 9 times out of 10, if not 10 times out of 10, and I'd love for the folks here around the room to either disagree with me or folks on the phone disagree with me, because I think it's a well-accepted fact, that if you self-insure, your overall healthcare spend is going to be lower. And there's a couple reasons for that. And you see them in my sub-bullets at the bottom here. For one, self-insured employers do not pay a risk load to an insurance carrier. When you work with an insurance carrier, you are unloading risk onto that insurance carrier. And they rightly are charging a load for that, or they are charging for the risk that the carrier is undertaking. Well, if you're self-insured, again, you are taking on the financial risk. You're taking on your own risk of your own employees' health risks, and therefore that same load is not there. So you at least have that reduction in premium with respect to your overall healthcare spend. Now, in addition to self-insuring, you're not paying the carrier a profit load. Again, you can make arguments that carriers, are charging too high profits, or their profit margin is too low. Depends on who you talk to. You're going to get both sides of the story. But the bottom line is the carriers are in it to make money, and I see no issue with that. But when it comes to juxtaposing self-insurance versus fully insurance, you have to look at the fact that carriers are charging a profit load, and that is part of the equation when you self-insure, which that profit load is not part of the equation, and therefore you do have a percentage of healthcare spend that you as the employer are saving by going self-insurance. The third sub-bullet here is something that Chris Haltmeyer alluded to, is self-insured employers are not subject to state premium taxes. They are not subject also to the ACA insurer excise tax. And there's arguably reasons for that. We don't need to go into it. But the bottom line is if you're not paying that tax liability, you as then that self-insured employer are seeing some sort of savings by self-insuring. And and really, I tend to think, is this the driving factor for every employer? No. But is it the predominant driving factor? I think the answer is yes. And that is, typically a self-insured employer can better manage their own employees' health risks, health and their medical utilization. And how do they do that? I mean, I'll speak to it in the next slide momentarily, but the reason I say, at least in my opinion, and others may differ with me, is that why a self-insured employer can better manage their employees' health and utilization is because the employer has a vested interest in making sure that their employee is healthy. One of the things that I say, as a former finance committee staffer, when I was up there, I would talk to the health staffers, and I would say, look, you have to understand the primary reason why employers offer health coverage is to attract and retain talent. And the second reason, very close to the top reason, is to make sure that their employees are productive, to prevent absenteeism and to promote presenteeism. And I'm not saying that insurance carriers don't share that same view of keeping their insured population healthy, but there is not the same vested interest in the insurance carrier side of the world versus the employer side of the world when it comes to keeping their employees healthy. So that's an important aspect as to why an employer would want to self-insure. Again, folks can argue whether they disagree with me on whether the carriers think that or not, but the point is employers feel that they can better manage their employees better than health, that is, better than an insurance company, which kind of gets to our how do employers self-insure. And then the last slide, I'll talk to some of this better managing health of their employees. But how do employers self-insure? As I stated, employers are taking on financial risk. That's what they're doing. In cases where employers have a lot of money on hand and have a lot of revenue coming in, they can pay for those health claims very easily. They have significant general assets that they can tap. But you know what? Most employers aren't in that position. They aren't rolling in dough. They don't have significant revenue that they could pay out of their general assets for these health claims. So instead, what these employers do is they utilize certain risk mitigation tools. And Chris Haltmeyer spoke to some of the various products that are out there, one being stop loss, being a tool, a financial risk mitigation tool. And there are additional variations of employers utilizing stop loss coverage with the level funded products that are out there. But generally speaking, a level funded product utilizes stop loss insurance, and stop loss insurance at the end of the day is a risk mitigation tool. And it's important for me to just stop to say stop loss insurance. It's an important distinction to make, because when I talk to staffers on the Hill about self-insurance, a lot of them don't pick up on the fact that stop loss really at the end of the day isn't health insurance. Now, we can make arguments that if you have a low enough attachment point, that the stop loss insurance is looking a heck of a lot like health insurance. And I don't disagree with that argument per se. But we have to understand what stop loss insurance is. Stop loss insurance is a risk mitigation tool that the employer signs a contract with the stop loss insurance carrier. And if the employee's health claims are over specified limits, either based on a specific employee or in the aggregate on all of their employees, the employer still has to pay that health claim. They still have to dig into their general assets or probably get a loan to cover that catastrophic cost. And then what the employer does is go to the stop loss carrier and say, hey guys, I had this big claim, you now have to reimburse me. And that is part of how stop loss insurance works. So it doesn't insure an individual employee. At the end of the day, it insures the employer. And that's an important distinction about stop loss versus health insurance. But again, I understand the argument of low attachment point. It may look a heck of a lot like health insurance for individual employees. Then the last part here, how employers self-insure is obviously they're taking on the risk of paying health claims. But in order to better manage the health and the utilization, as I talked about in the slide earlier, employers are taking advantage of different tools that are out there. Your wellness and disease management programs, your data analytics to identify health claims trends, which then almost allow you to come up with creative wellness programs that could, again, better manage the health and productivity of your employees. And then they're very transparency tools. We hear a lot about transparency, and there's a lot of barriers to providing meaningful transparency, both on the price side and the kind of quality and outcome side. We're not going to have a debate on that or a discussion on that, but there are transparency tools that employers do utilize that are intended to help their employees become a better consumer of health insurance, and again, it's intended to better manage their costs. So really, this is the last slide that I'll go through, and then we'll open it up for questions. Another interesting and I think advantageous side to self-insurance is incorporating value-based care strategies into your health benefit offerings. And what are these value-based care strategies? Well, you see them in my sub-bullets here. But let me first pause to say, many of the large self-insured employers out there are the more likely types to incorporate these value-based care strategies into their benefit offerings. And it's less likely that the small employers that Paul said, there's a trend towards small employers self-insuring, they're less likely to engage or incorporate these value-based care strategies into their benefit offerings. But it's not to say that small employers are not pursuing these value-based care strategies and taking advantage of them to, again, help them better manage cost, help them better manage the productivity of their employees, which then has an overall impact on their healthcare spend. And just digging into some of the value-based care strategies, to see them here, one is reference-based pricing. People might have opinions on reference-based pricing, both pro and con, But essentially what it's intended to do is to ask the employee, hey, if you need a knee replacement or there's certain medical episodes that we're going to specify that you could go to a specific provider that's in network, and we're going to cover X dollars of this particular procedure. You could go to provider X over here or provider A over here that charges you, X, Y dollars, and you can go to provider B over here that charges you Z dollars, but if Z is higher than X, we're only going to cover X. You're on the hook for Z, and to an extent that steers, and maybe that's incorrect or people might have issues with that, but that essentially steers the employee to that provider that, let's say, is charging a certain cost for a particular medical episode. Bundled payments just are negotiated payments for certain medical episodes. Centers of Excellence programs are more or less a version of bundled payment programs where employers, or better stated, providers, are part of this Centers of Excellence program in which providers participate meeting certain performance metrics and performance outcomes, and then there's a negotiated bundle payment for a specified medical episode which employees of these employers go to, and there's oftentimes reduced cost sharing associated with that. Direct-to-employer contracting is almost like an ACO type model where there's some shared risk associated with the employer and the provider when it comes to costs. Chronic care management programs are oftentimes utilized by both large and small, and what that essentially is intended to do is, look, we have high medical utilizers out there, and we want to help them better manage their chronic condition, as opposed to not getting the necessary care and waiting for things to get worse, and then obviously that particular person is more expensive on the back end. And then lastly, consumer-driven healthcare arrangements can be paired with HRAs and HSAs. It just goes with the whole consumer-driven healthcare debate, which again we won't discuss here, but is intended to lower costs and make consumers a better, or make employees, that is, a better consumer of healthcare. So with that, I will stop talking and turn it back to the group and see if there's any questions.
Thank you to our panel. We do have a couple of questions, and I want to kick it off with one to Paul. We've been talking a lot about smaller plans and smaller companies, but you did also mention and show on one of your slides that there's been a drop in the larger plans offering self-insured, or large companies offering self-insured plans. Can you speak to that?
Yeah, so when I saw the increase in self-insurance among smaller and mid-size, no surprise there. It's exactly what we expected to see. But when I saw the drop in self-insurance among larger employers, I was quite surprised by that. I didn't have an obvious answer to it. So I started asking some people in the field that deal with self-insurance and large employers. And while I don't have evidence to show you, the comments I got back were along the lines of, there are some carriers that are concerned about losing business. So they're basically cutting deals with some larger companies, even though they're moving them from self-insurance to fully insured plans. It's a way to keep them with that carrier. So because if they switch to a different carrier, they would be losing whatever ASO fees that they would be getting. They tend to see this, even though it's keep in mind our large employer number is 500 or more. They're seeing this in the smaller end of the large employers. They're not seeing it with the jumbo employers. They're seeing it more in the plus or minus, but in the 1,000 employer range. I'm much more likely to see it there. So it's interesting to me that you do have carriers that are, it's a competitive market, and carriers do react to, the nature of this market. It'll be interesting to see if it continues, is it a one-time savings that the employer is getting? Do they switch back to self-insurance at some point? I mean, those are some of the dynamics we need to look at that we can't really capture from the data we get from MEBS. But there are other ways to capture that if you follow the market closely.
Thank you. Well, let's turn to the questions that have been posed in our Q&A comment section on the screen.
So one of the questions we got was about additional regulatory requirements that a company would be subject to as a fully insured plan that they wouldn't be subject to as a self-insured plan that they wouldn't be subject to as a fully insured plan. Chris Holtmeyer, you want to take that one?
Yeah, I can start. I think the regulatory requirements for the insured plans, especially for the small employer market, are much more significant than those for self-funded. The biggest requirement, I think, is what Chris Condalucci referenced, which is that they are bearing the risk. So it's not so much regulated in a lot of states, but they really do have to be able to handle the additional risk that they take on when they self-insure. But in pretty much every way, I think the insured market is regulated more stringently than the self-funded market.
Yeah, and I would even just enumerate some of those regulations. I mean, when it comes to the small group fully insured market, those plans are subject to the essential health benefits, the adjusted community premium rating rules, the actuarial value requirement, and the single risk pool. Those four requirements that I just articulated or enumerated do not apply in the self-funded context, regardless of size. So even if you're a small employer, you are not subject to those four ACA insurance market reforms. And to an extent, one could argue, and this has been a prevailing argument, that many small employers are shifting to self-insurance to get out from under, let's say, those four regulations that I just described. I personally think that there is something to that argument, but I don't think that it's the primary reason why smaller employers are self-insuring. It's just that the small group market, for one reason or another, which is partly due to the regulation, is just not evolving in the way the drafters of the ACA, for example, would have liked to have seen the small group market evolve, and we're seeing fluctuations in costs and high premium increases year over year, and that's largely what's driving the shift from fully insured to self-insured. The other aspect of self-insurance versus fully insured is if you're a self-insured plan, you are not subject to state benefit mandates, and state benefits mandates are essentially incorporated into the essential health benefits requirement. So at least when we're talking about small employers, it really doesn't matter when it comes to the fully insured market, but you're not subject to state benefit mandates or the essential benefits in the self-insured context, which does have somewhat of a savings. But again, I'll counter it to say, many of the small employers and large employers who self-insure offer benefits that are almost similar in scope to benefit mandates in the state and or the essential benefit mandates that are set forth under the ACA. Yes, there's some variation, there's some cost savings as a result of that variation, but primarily to have a competitive plan to attract and retain talent, to keep your people healthy, you typically see self-insured plans being on the more comprehensive side. So those are just 4, 5, 6 examples of regulation that differs between the fully insured side of the world and the self-insured side.
What about annual and lifetime limits?
That,
how does that factor in now to
yeah, and I'm glad that
insuring?
you asked that, because I mentioned, 6 regulations that apply in the fully insured context that don't apply in the self-insured. But the typical almost ACA reforms that you hear people talk about apply equally in both fully insured and self-insured. And what I mean by that is that I'll refer to them as the ACA coverage requirements. And that includes the no annual lifetime limits. That applies in the fully insured context as well as self-insured. The no cost sharing for certain preventive services applies in the fully insured as well as the self-insured. Can't deny someone coverage if they have a pre-existing condition applies equally in both fully insured and self-insured. Covering adult children up to age 26 applies equally. It's those coverage requirements that do apply equally. The only kind of exceptions to the ACA insurance rules that apply to fully insured versus self-insured is really just the 4 that I enumerated, which is the essential benefits, single risk pool, actuarial value, and premium rating rules. So there are, again, arguably significant coverage requirements that apply in both cases.
Do you want to say more about the potential regulatory changes around stop-loss insurance? Is there, what's the outlook for change? What might change look like?
Yeah, so I guess I can
speak to that. But yeah, go for it.
So, I think that, the NAIC has looked at whether they should update their Model Act. The last time was in 2012. Yeah, the stop loss thresholds that they have in that model are outdated, given the medical trend increases in the market. But when they evaluated that the last time, there wasn't adequate support to update that model. So I think you really are left to what individual states decide to do with regard to the regulation of stop loss coverage. And most states today don't have specific laws that govern these attachment points.
Yeah, and I'll pick up off where Chris H. Spoke to is the attachment points. So, but first by saying, stop loss is an insurance product. So the state does regulate stop loss insurance just like any other insurance product. So there are licensing requirements, et cetera. Now, where you might see additional regulation, or where folks have talked about additional regulation, maybe I'll say it that way, has been in this area of attachment points, where many ACA supporters and, let's say, proponents of the fully insured small group market, concerned that there might be a shift from fully insured to self-insured, said, hey, we should prevent small employers from shifting from fully insured to self-insured. And there is no law that can be passed at the state level that can really prevent a small employer or that can regulate self-insured plans. So that just can't happen. So the best way to go about preventing small employers from shifting to self-insured has been to look at attachment points for stop-loss products. And California is a perfect example of a state that actually passed a state law that said if your attachment point is below a specified dollar amount, I think it's like $35,000 for a specific stop-loss, the spec aspect of the stop-loss policy, and I can't remember that maybe it's 120% of claims for the aggregate, then that stop-loss policy is going to be recharacterized as health insurance and regulated as such. So in other words, if I'm in small employer in California and I want to self-insure, my stop-loss product cannot have an aggregate attachment point of less than $35,000 or less than 120% on the aggregate. So I got to get something like $50,000 and 150%. But I could get that type of product, and that's okay. And again, the reason why I believe California and some other states looked into this, California is one of the few that pulled the trigger on it, was to protect the small group market. And it really comes down to states and the NAIC not wanting to go far enough to say, yes, we need to regulate stop loss and the attachment points because it's a matter of choice. Employers, employee benefits, as we all know, is voluntary. Like, an employer doesn't have to offer coverage if they don't want to. And then when it comes to an employer deciding, then they choose, well, I'll fully insure or I'll self-insure. And they go through the financial risk and all the points that I brought up, and they'll go through what the cost is and the issues associated with some of the points Chris brought up and determine where they want to go. And that's why I think you haven't seen as much regulation in the stop-loss side of it. And personally, I think that's the right decision. Others may disagree with me, but I think that's the right decision.
And I don't know that we'll see that many more states regulate, the attachment points in the small employer market. I think it does bear thinking about whether the federal rules are actually the right rules in the small group market. And at some point, if we do see some of the problems that I'm concerned about in the small group market, we may need to go back and evaluate those rules as well.
So we have a couple more questions that we're going to try to address in the last few minutes we have. One relates to churning. Do we tend to see employers moving from self-insurance to fully insured plans in anticipation of claims they may see on the horizon? They may have some high-cost claimants coming through or they may think they do. And does it even will they even get a good deal if they're going to be experience rated, let's say, in the fully insured market? Does it even make sense to do that?
So one of the things that we're starting to see in the small group market is that when employers come up for renewal, most of this business is broker-driven. They will get quotes for a self-funded option and an insured option, and the broker will give them advice as to which option is the better option for them, based on their risk profile. So some of that has been slow to occur in this market because of this, keep what you have transition. But I think when employers come off of that transition policy and are now buying, getting the rate that they would have for an ACA compliant policy, brokers will be giving them, these different options. So you may see more of the healthier, lower cost firms move to a self-funded product for that reason. One of the things that we've also been concerned about is some of the marketing materials for some of the firms that are offering coverage in this market really do say, if your risk deteriorates, you can move back to the insured market. And so that's where I think that churn concern comes in. Do they only opt for this option when it's financially attractive? Given that this is a guaranteed issue market, they cannot be denied coverage by an insurance carrier for a comprehensive ACA policy. So that's something that we're going to be monitoring very closely. One interesting dynamic I just wanted to mention was that, we are actually seeing, some of our members are reporting a slight increase in coverage in the small employer market now, the insured small group market. And we think that might be due, and this is not reflected in this NEIC data, may be due to the worsening condition of the individual health insurance market, where you had some micro groups, 3, 4, 5 life groups that moved from the small employer market to buying coverage in the individual market. And because premiums have increased so much in the individual market, you may see some migration back now to the small employer health insurance market.
And I'll say this, Paul, just to say, the folks that self-insure are in it to win it. They do it for a reason, and they expect to be successful. Now, there are situations where there are some catastrophic health claims, and at that case, then they'll pivot back to the fully insured market. But generally speaking, you self-insure, you're kind of on a glide path for the next 5 years or so, and you're just dealing with it. But you can't overlook that there is some churn, because that's the nature of how the market works, and the rules allow you to pivot back. But generally speaking, self-insurance folks are in it to win it.
We have one last question. To the degree we can even answer this one, do self-insured companies get the same provider rates that fully insured companies get? Is there any reason to believe that they don't get the same rates if they're contracting? If you're contracting with an insurance company, either on a self-insured basis or a fully insured basis, why wouldn't you get the same negotiated rates? Right? I don't know that carriers have different negotiated rates providers.
Now, I think there are a set number of networks that are generally made available to both types of arrangements. So I'm not sure it does differ.
I mean, we did see a study, though, that did identify that carriers did have different negotiated prices for the same medical episode. So I think it really comes down to almost size and negotiating power. At least based on the study, whether it's accurate or not, the study did say there's a variation among carriers in negotiated prices. When it comes to the self-insured world, I think the negotiated prices come down to how many lives are going to be going through that provider's door. Like this direct-to-employer contracting, where a self-insured employer will contract directly with the employer. If you're a smaller employer and you don't have many lives that are going to be going through that provider's door, the provider's not interested in a direct-to-provider contract. They're going to say, you're not enough lives, it's not worth our while to give you a discounted rate, so we're not going to do it. But if you have 100,000 lives or more, the provider's going to be like, well, of course, I will welcome all your lives coming through my doors, and therefore I will make it worth your while, because you're going to make it worth my while based on volume. And I think it comes down to size.
It may differ based upon the kind of arrangement that the employer has with either the provider or the insurer.
That's been my experience.
Okay.
Well, thank you very much, Paul, Chris H., and Chris C. And thanks to University Conference Center for hosting today. Chris H. did mention HSAs, and for EBRI members, I wanted to mention that there will be an infographic and a PowerPoint on HSA engagement next week. If you want to become an EBRI member or to donate to EBRI, go to EBRI.org. Our next webinar will be on June 20th and will feature an examination of recent retirement policy initiatives using EBRI's retirement security projection model. And again, there will be a replay of today's webinar on YouTube. Look for that link also in Monday's EBRI. Thank you again for joining us, and have a great rest of your day.